Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Cansino Biologics Inc. annual report. Cansino Biologics Inc. is a Chinese biotechnology company that specializes in developing, manufacturing, and commercializing vaccines. The company offers a diverse range of products, including Convidecia and Adfiven-Co-V for COVID-19 prevention, as well as vaccines against Ebola virus, Adfivebov, meningitis, McVitwo and MCV4, and pertussis, DTCP and DTCP booster. In addition to these established products, Cansino Biologics is also developing several new vaccine candidates. These include a pneumococcal vaccine, PBPV, that provides serotype-independent protection against pneumococcal disease, PCV13I, a pneumococcal conjugate vaccine, and TB booster for individuals who have received the BCG vaccine. The company's pipeline also includes various preclinical stage products. These include combination vaccines such as DTCP-Hib combo and C-2000, 200 and 1-DTCP, as well as vaccines targeting specific diseases such as meningitis, C-2023, multivalent conjugate disease, C-2028, shingles, C-2032, polio, C-2036, tetanus, C-2047, and others. Cansino Biologics Inc. maintains a market capitalization of $11 billion, broadly in line with the industry peer group. Cansino Biologics Inc. trades at a higher price-to-book ratio of 1.02 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 38% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline for a company can be attributed to several key factors. On the growth side, commercialization of meningitis in China's mid to high-end vaccine market and the launch of new blockbuster vaccine product, Inusha, have significantly contributed to increased sales revenue. The consolidation of commercial product portfolio and achievement of R&D milestones have also played a crucial role in driving revenue growth. Furthermore, the company's leadership market position and precise marketing efforts for meningitis have led to significant growth in sales volume. Expansion into overseas markets through technology transfer agreements with partners has generated additional revenue from semi-finished product sales. The progression of R&D efforts, enhanced international collaboration, and optimized production planning have also contributed to increased revenue. On the other hand, a decline in revenue is attributed to a decrease in trade receivables over 2 years and an increase in expected credit losses on trade receivables. However, there are no clear drivers of revenue decline mentioned in the report, indicating that these factors may be contributing to the decline, but their specific impact is not explicitly stated. The company's net income saw a significant increase of RMB 18.8 million, representing a growth rate of 37.7%. This substantial rise in net income can be attributed to various factors, but the exact reasons are not specified. A closer look at the profit margins reveals some interesting trends. The gross profit margin has increased from 70.4% to 75.4%, indicating that the company is able to retain a larger portion of its revenue as profit. This improvement in gross profit margin can be attributed to various factors such as cost reduction, efficient production processes, or better pricing strategies. However, not all segments have seen an increase in profit margins. The vaccine products segment has witnessed a significant jump in gross profit margin from 71.4% to 80.5%, suggesting that this particular product line is highly profitable for the company. On the other hand, the CDMO, Contract Development and Manufacturing Organization segment, has experienced a decline in gross profit margin from 38.2% to 13.2%. This decrease may be due to various reasons such as increased competition, higher operational costs, or inefficient production processes. Overall, these changes in net income and profit margins suggest that the company is experiencing growth in certain areas while facing challenges in others. To sustain its growth trajectory, it is essential for the company to address the decline in CDMO segment's profit margin and continue to improve its overall efficiency and profitability. The financial health of a company can be gauged by its ability to generate positive operating cash flow. This metric indicates whether a business is capable of producing sufficient funds from its core operations to meet its financial obligations and invest in growth initiatives. According to the provided information, the company has successfully achieved this milestone. As stated on page 83, the operating cash flow for 2025 stands at $77,857, which is a positive figure. This indicates that the company's core operations are generating sufficient funds to support its financial requirements and investments in growth strategies. The generation of positive operating cash flow is a significant achievement for any business, as it demonstrates the company's ability to manage its finances effectively and make strategic decisions to drive growth and profitability. The company's debt level has undergone significant changes over time. Initially, short-term and current liabilities decreased substantially on page 26. This trend continued with a total debt decrease from RMB 3,048,260 to RMB 2,223,956 on page 81. Furthermore, the total debt level dropped from RMB 1,990,706 to RMB 1,275,470 on page 143, representing a notable minus 35.6% change. Additionally, total liabilities decreased by 26.5% from RMB 2,474,598 to RMB 1,819,603 on page 150. The interest expenses also experienced a significant reduction. On page 22, interest expenses decreased by RMB 21.4 million. This downward trend continued with a decrease in interest expenses on bank borrowings from minus 60,251 to minus 38,883 on page 118. The change in interest expenses was notable at minus 32.1%, as mentioned on page 148. Overall, the company's debt level and interest expenses have undergone substantial changes, indicating a reduction in financial liabilities. Management is optimistic about the company's prospects, aiming to solidify its leading brand position through continued consolidation efforts. This includes promoting new products and enhancing synergies among core offerings. The company also has a strong financial foundation, with sufficient resources for daily operations. In terms of growth, management plans to invest heavily in the Cansino Innovative Vaccine Industrial Campus project, allocating RMB 244.7 million to enhance manufacturing capacity. However, there is some uncertainty surrounding future demand for vaccine products, which may impact inventory provisions. Despite this potential challenge, management's overall outlook remains positive, with a focus on driving growth and expansion through strategic investments and product development. In reviewing the financial activities of the company, it is clear that they have engaged in two key practices. Firstly, the company has a history of paying dividends to its shareholders. This indicates a commitment to returning value to investors through regular distributions. Secondly, the company has also undertaken share buybacks as part of its financial strategy. By repurchasing shares from the market, the company aims to increase shareholder value and potentially boost stock prices. Concerns about inventory buildup are evident in the company's financial reports. The impairment loss of inventory has increased significantly, from RMB 23,520 to RMB 52,815. Additionally, gross amounts of inventories have decreased by RMB 20,385,000, and net write-downs of inventories have increased by RMB 78,172,000. Furthermore, the company has mentioned concerns about inventory buildup on page 130. Moreover, there are also concerns about supply chain disruption. The expected time of full utilization has been extended to the end of 2026 due to global public health incidents and macroeconomic factors. Potential impairment risks exist due to uncertainties such as obsolescence of inventory, quality control issues, and complex manufacturing processes. Disruptions in supply or increases in raw material costs can also significantly impact operations. That concludes the financial summary for Cansino Biologics Inc. Feel free to comment below, and I will be happy to answer them when possible.